Hi, okay. So today we'll start our webinar, starting with Keppel DC REIT that announced their acquisition, followed by China Weekly, US Weekly, Singapore Weekly, and our technical analysis. About on Monday last week, Keppel DC announced a double acquisition of the first one of two assets. First of all is the Keppel DC 4, as well as One at North. So Keppel DC 4 is a co-location asset that is located in Singapore. The stabilized yield for this asset is 7.5%. But as it's a relatively new asset, it's about 2 years old, they have negotiated for rental top up or rental support for this asset, and the rental top up of 8.8 million will be covered over 2 years, bringing the MPI yield to 7%. The second asset is One at North. It's located in Woodlands and it's a master lease asset. It's the first master lease asset in Singapore. The initial yield, the yield will be 9%. So for the acquisition of these two assets, the DPU accretion is from 9.4% to 12.4%. The range is due to the fact that the REIT will have to apply for tax transparency status for Keppel DC 4. The reason for the tax transparency status is, first of all, because data centers in Singapore are not automatically granted the tax transparency, so they have to apply for it. This happened with Keppel DC 1, 2, 3, and 5. And the most recently acquired Singapore asset was Keppel DC 5. It was acquired in June 2018, and the approval for the tax transparency was granted in January of 2019. So that took about 6 months. So in terms of the structure of the acquisition, the entity that holds KDC 4 is similar to all the other KDC 1, 2, 3, and 5. So we do expect KDC 4 to be able to get the tax transparency status, and the timeline for this approval is about 6 to 9 months. So how do we view this proposed acquisition? It is highly DPU accretive, and however, because of the equity fundraising via private placements and preferential offerings, it will actually reduce the DPU for 2019 by 0.42 cents. For the DPU for 2020 will increase by 0.37 cents. So this actually translates to a DPU growth of 15.1% in FY20. The price to NAV is currently at 1.6%. We feel that this is relatively well supported due to the greater investor appetite for yield instruments. This higher price to NAV, given this lower interest rate environment, is expected to persist. The placement for this acquisition by Keppel DC was extremely well supported, and it's one of the highest oversubscribed placements. Is at 9.3 times. Okay, so in terms of portfolio metrics, this acquisition, in terms of portfolio metrics, this acquisition will actually improve WALE by 1.1 year to 8.9 years. It would also increase occupancy slightly from 93.2 to 91.4%, and leverage will fall by about 1.3 percentage points. This better lease diversification can be seen through figure 1, where the co-location proportion in the portfolio actually falls slightly from 75% to 72%. And the master lease asset, which is One at North, will actually provide income stability and visibility. Apart from that, the AUM in Singapore will increase from 51% to 62%. This is actually viewed favorably because Singapore is a very desired location for data centers. We revised our target price to incorporate this acquisition, and we also lower the cost of equity slightly. This is due to we feel that a lower cost of equity is warranted as Keppel DC's cost of borrowing has actually been falling over the years. Currently, it's at 1.7%. Our target price translates to a DPU yield of 3.8% for FY19 and 4.4% for FY20. So moving on to Mike for China Weekly.
Thanks, Natalie. For the China Weekly, For C-Chips, we are positive on C-Chip due to the large addressable the global online travel agent market and its leading positions in China's and unique core competitions. C-Chip currently trades at the PE ratios of the 36.8 and PB ratios of 1.2. C-Chip is international online travel agent providers, which provide the accommodation reservations, transportation ticketing, package tours, and the destination service. The key products include cchip.com's Qunar, Skyscanners, and chip.com. Overall, still, we are thinking there's the three key things will affect the C-Chip's business. The first thing is we are positive on the C-Chip because of the it's a large addressable global market with a low penetration rate. The C-Chip acquired the Skyscanners on 2016. After that, the Scanners retains its positions as the top two the most popular travel brand search platforms in the world. We are thinking the Skyscanners and the Trip.coms will provide C-Chips the favorable access to the global business. Secondly, the C-Chip remains the most popular online travel agent in China. On 2018, the online travel agent business accounted for total 60% of the total travel spends, in which C-Chip accounted for more than 60% of this business. And with their core competence, we are thinking the C-Chips will remain its positions as the most popular travel agent. Thirdly, since will affect the C-Chip business, we are thinking is Hong Kong's and Taiwan's distributions. The China announced that it will stop issuing individuals the travel permit to the citizens in 47 mainland cities since August. And because of the Hong Kong and the Taiwan's represent approximately 1/3 of the total the Chinese outbound trips, it will this instance will in fact C-Chips about 4 to 5% decrease in the revenues. For the stock performance, overall, we are seeing a little bit just an adjustment in the stock performance the last week, mainly because of the China's they didn't decrease the ML interest rate, but to be noticed that China's last Friday's decreased the long premier rate down 15 basis points for the 1 year's the long premier rate. So we are continuing the China's monetary policies will be the step into the losing stage. This is a list of the upcoming earnings released. I will move on to the variance for the US weekly.
Thank you, Mike. For today, I will share on behalf for Edmund. So let's move on. So for the sector performance, due to the oil, the Saudi attack, the returns for the energy sector is at 6.8%. However, the best return to date for a month is the healthcare and information tech, and year-to-date return financials did very well. So cumulative returns we have 21.7% against the S&P 500. So let's move on. So for this is the earning result days. There's Nike, Pepsi, and COSTCo. So during that, we will share about COSTCo. So for COSTCo wholesales, there are two key drivers for COSTCO. First is the robust international competition, especially in Spain, Taiwan, and Mexico. If you do it in geographical terms, Europe, Asia, especially East Asia, and Latin America, Mexico is growing very strong. Also, for major product categories, COSTCO has most of the products in their companies, and it grew at a mid-single digits, is around 5 to 8%. So for the call, we have a technical buy rating for COSTCO, and if you look at the fundamentals, right, the P ratio is at 25.8, near is 10-year plus 1 standard deviation range. However, we believe the multiple of COSTCO is justified due to its defensive nature, strong competition and growth opportunity in the international market. So the core US sales was up 5.9%, above the 5.3% in July and June each. The competition was mainly due to strong consumer spending in the Midwest, especially Texas, and of the West Coast in Los Angeles. Let's look at the neighbor, Canada. Due to the US dollar strength, FX outperformed and was up 6.1%, and 5.9% is in against Spain, Taiwan, and Mexico, and therefore Japan and Mexico. So let's move on. For category perspective, for all major categories have grown in the mid-single digit, like what I mentioned. Competition for foods and sundries were in line with July, led by candy, dairy, and liquor. All these are consumer staples. Hardlines were in high single digit with strength in automotive, majors, and sporting goods. So let's look at the technical graph. So we have a technical buy, but we, however, if you want to have a risk to reward ratio, we suggest a buy at 279 to 270. There's an area of strong reason why, because there's a strong area of demand, and after a strong move over here. Look at the traditional technicals. We have a short-term bullish MA cross, aka a golden cross. And for this, and also the immediate uptrend line is still being supported, and the area demand confluence with the immediate uptrend support line, and 200 MA is still trending very strongly. So move on. We have some. I'll move on. I'll share about the Dow Jones Industrial and Transportation Index, aka the Dow theory. Based on the Dow theory, we have a gloomy outlook. So for the strength of our view is still the same sharing session on the 8th of July, except that the Dow transport did make a recovery, but however it's still kept at a resistance below 11,000, and this is something to be worried. As I mentioned on 8th of July, the divergence actually the divergence of the industrial and transport is actually a worrying factor should there be any recession. And due to a diamond top pattern, we are expecting Dow transport to actually break lower. And if you look at the divergence, right, the September 2018, May, sorry, and then in the recent July, we have a strong area of divergence that happening where Dow the industrial make new high, but while the Dow transport keep making new lower highs and cause a divergence. So highly reversal is the divergence is highly possible with the diamond pattern. But however, there may be a black swan event, and although Dow actually break below 27,000 as of industrial break 27,000 as of last Friday close, but actually there might be a surprise 28,000. When 28,000, we believe that this might be a sharp reversal price. Otherwise, this supply area of the Dow Industrial of the weekly chart will unfold the bearish correction of the wave E. So with that, I move on to Paul for the Singapore Weekly.
Thanks, Baron. Just move on to the Phillip Singapore Weekly. In terms of the macro data out there, it was all about exports. I think you still see Singapore exports still weak. It was down 9%, probably the 10th month of decline. And worst hit was the electronics exports that were down almost 26%. So the electronic exports are bearing the brunt of the weakness in exports. Singapore is not unique. We also see weakness in the Korean exports. Only Taiwan has been holding up better. In terms of the US data, obviously the grabbing the headlines has been the 25 basis point cut in interest rates. And of course, there's less certainty on the rate path. But the other positive data point has been the housing market seems to have some resurgence. The housing starts were actually in the US almost 12-year highs. Housing starts are basically new construction on new homes. In terms of the emerging markets, I think what we're seeing across the region, probably the big macro story is that we see a lot of stimulus by various governments. We see India cutting their corporate tax, a massive 25 5% from 30 to 25. We also see countries around the region all cutting interest rates to historic lows like Brazil, and even Indonesia also cutting their policy interest rates. In terms of the trade talks, obviously not optimistic. I think the Chinese negotiators cut short their trip. And I think Trump said that he's not looking for a partial deal. So we don't not optimistic of any deal coming through. And anyway, in the most recent Democrat candidate debates, we also see that when they've been asked about whether lifting of tariffs, I think most of the candidates also mentioned that they're not looking to lift any tariffs on China, even if they got elected. So this this tariff barrier or called trade war will not get any relief, even if we have a new government out of the US. In terms of our tactical views, I think we still see the markets moving sideways. I think we still look at buying yield. And of course, in terms of preference, it's still the REITs, especially those REITs that are listed in the US REITs listed on Singapore that we mentioned a couple of weeks. Okay, and in terms of the other point we want to make is just that it seems that the manufacturing downturn looks quite exaggerated. Like we mentioned, exports already on the 10-month, and compared to some of the historical data, it looks quite quite elongated, and we probably think that probably by year end there could be some improvement in the data, and we should start to get repositioned for some electronics rebound by year end. In terms of the key data for next week, most of it will be all the tariffs that's going to be imposed, whichever list you want, from 25 to 30 to and 15% on the second list. Nothing much. This is just some of the charts beginning to see, although it's still declining, beginning to see some improvement in some of the data points. It's not across the board, but we're hopeful that maybe by year end there could be some better electronics data, because the weakness has been almost, by some data points, almost 2 years of decline in the electronics. Okay, that's it. Yeah, any questions?
Hi, okay. So we have some questions about Keppel DC. First question is about whether or not the TP is cum rights or ex rights. This is my TP actually factors in the enlarged share base, so it's ex rights TP. There's also another question about why Keppel DC REIT bought 99%. No, this is not odd. Actually, there are a few REITs that actually do this. The other 1% is actually held by Keppel DC Holdings. So it's the manager in a way. Another question about US REITs. So of the US REITs listed on the SGX, we actually have a preference for the office segment. For example, Manulife is worth a look. Prime as well.
There's a question on COSTCo. That panelist says that COSTCO has formed a lower high. Yes, it did form a lower high, but if you can look back to my slides. Let's see. Okay, so for the weekly chart, yes, COSTCO did make this not update chart, of course, did make the lower high, but on the daily chart you can see that actually there's a falling wedge in formation. So we believe that price will actually hit 279 and then rebound thereafter, unless price actually breaks below 262, okay, which is the daily low over here. Then there might be a possibility that a downtrend will be forming. But even though there's a possibility of a downtrend, but the longer term trend is still on a bullish manner, the bullish trend. Why? Because the short term, all the short term and mid term moving average are pointing upward. The longer term moving average is also at an upward curve. It's not showing any flattening curves of the moving average. And some more, 23.6 is actually a very strong uptrend move as well. I hope that answers your question. Thank you. Hi, there's a question on the outlook of the gold price. From the technical perspective, gold price actually has resumed its bullish upward above 1500. However, do take note that there's a resistance at 15. There's a 1535. Should that level being rejected, there will be a potential head and shoulder, And if the head and shoulder do have a formation and then it reject at 1535, like I mentioned earlier on, the next target price they will go for rebound is at 1450. I hope that answer your question. Thank you. Hi, there's a question on STI technical outlook. So based on the weekly chart, the time I will share that it's actually it rebounded, the STI rebounded like 3 weeks ago at 3086. And then, however, the price is capped at 3214.91. So currently we are in uncleared range bound momentum. So unless 2,956 is broken or 2009 to round off, then we will have a clear direction of STI heading into the bearish momentum. But otherwise, for STI, we are currently in a very unclear manner. I hope that answers your question. Thank you. Hi, there's a question on what's the best strategy right now for trading short term. I can't give you a very generic question answer, but what I can tell you is for now in the uncertainty market, it's best to have a tight stop loss and then look at the chart, look for area of value, preferably at a lower range or bound of the retracement, and then have a tight stop loss. That will be the best strategy for trading short term. Thank you. Hi all. So is there any final question? If not, we will end off this current session and we will see you next week. Thank you very much.